Welcome to our At Retirement webinar. Thank you for joining us for the next 2 and a bit hours. This session, we actually took out on the road as our first physical event of 2021. And I must say, it was very good to be presenting to actual people again. That said, lots of you couldn't attend due to the location, so we're giving everybody the opportunity to listen in today with this webinar. I'll be spending the next 10 minutes giving you a quick business update and explaining how AJ Bell Invest Centre can assist you and your clients with the decumulation phase of retirement planning. I'll then be handing over to our 3 main speakers of the day, who I will introduce in due course. So please ensure that you have a drink to hand and you're comfortable, and we'll get started. We'll start off with a look at the financials from the past year. If we have a look at our financial year 21 interim results, you'll see strong numbers across the board, increase in retail customers, an increase in assets administration, revenue, and profit before tax as well across the board. That's in comparison to our results from the same time last year. Profit before tax being one of the key kind of drivers which advisors are looking at the minute when doing their platform due diligence, as there's been a lot of consolidation which has been going on in the market space, some to private equity and some to public firms as well. Looking back a little bit further, so we've got 6 or 7 years here looking at retail customers and assets under administration. One thing you can see from this is consistent growth over the years. We're in the space where we organically grow the company, working with business owners and advisors. We're not in the space of acquiring big businesses and adding that to our book. On a side note to that, you may have seen that we'd acquired a small platform called Alpha, which has been rebranded AJ Bell Touch. That was a technology platform which we bought. There's no live customers, and you should hear something further on that later this year. Moving on, we'll take a look at our financial strength, which has been done by AKG. We've got a B+ in that space, and if you take out some of the companies which are life assurance companies, the likes of Standard Life, Aviva, so on and so forth, you'll see we're at the top of the independent scale, similarly to Transact and Eccentric in that space as well. On top of that, we have a regulatory commitment to keep 150% of our regulatory capital as well. We'll now move on and have a quick look at the ease of use of the platform. During the transition to COVID last year, Platforum did a review of the market space and looked at a couple of different metrics. Here first, looking at the ability to adapt to the new working environment, how flexible we were with the movement to electronic signatures, how quickly we moved our processes to be able to accommodate what was going on in the world. It's really pleasing to see from these numbers that the vast majority of our advisors who use us have put us down as very good or good. And in comparison to our peers, we're leading by a good margin. Moving next, the ability to transact new business with ourselves. Again, strong numbers across the board, looking at very good or good. And some of the changes which we brought around included the ability to now add applications without any paperwork on our new V2 system. And that works for any of our standard cases. Moving on to customer service. Customer service is one of the key metrics which was disrupted with the transition to working from home. A lot of platforms suffered, but we were able to set up a great process working from home. And again, looking at the numbers across the board, a lot of our advisors, very good or good. And we were able to maintain those service levels, and we've had some good write-ups in other publications, how our service has been over the past year. Moving on to the platform user leaderboard, and we came out at 4th in this position. We tend to tussle and change at the top between Parmenion and Transact in the top 4 spaces there. And again, metrics which go into this review include profitability, usability of the platform, charging, and advisor perception as well. Breaking those results down a little bit further, we look at AJ Bell having the highest satisfaction levels, seeing us go up by 4% to the comparative quarter last year as well. And that's on the basis of advisors who are using us as their preferred platform as well, so they have a large amount of AUA with ourselves. How can we help during the retirement phase? The first thing which we did last year, at the start of last year, we did a bit of a segmentation exercise. We found that our pension product was more geared for higher value clients, and as such we were losing some business away at the lower end of that segment. What we've done, we have now created a new pension account, the retirement investment account. It takes away some of the bells and whistles of the full SIP, so you don't get access through to commercial property or to off-panel arrangements, but it does give you full access through to our stockbroking platform, the funds and shares service, to be able to run models, fund pick, outsource to a DFM on there as well. And the change with this is that it brings an all-in pricing point of 0.25. On top of that, there's no charges for any account setup, for drawdown, transfers in, and any online dealing as well. Just taking a look at how we now compete across the market at the drawdown space. Previously, as you can see with our old SIP, once a client got past £200,000, super competitive in relation to our peers. But prior to that, we were expensive due to some of our fixed administration fees. Now with the retirement investment account, you can see whatever client size you have across the board, you can get a compact pricing structure for them. And I'll leave that up for a second just so you can have a quick glance at some of our competitors on there who you may use. Again, how can we assist with drawdown clients? So there's a lot of functionality on the platform available to advisors to help clients and manage their income as well. We start off with cash management tools, which works both for clients who are accumulating or clients who are in the decumulation phase. You can set up regular disinvestments on an account to ensure that there's sufficient cash available in order to pay any client's income. We also have a segregated cash account on the pension. Now, this is something with the release of our recent third-party DFMs, which advisors have been really keen on. Some platforms have a single cash account, and when DFMs rebalance on that platform, it draws the cash back into the portfolio. With ourselves, you can actually segregate and regularly move money away to this segregated cash account, and from there, the cash is protected and isn't touched when any rebalance is performed on the account. We look after the full range of flexi access options, from flexi drawdown, cap drawdown, again looking after PCLS, UFPLS payments and income payments as well for clients. The ability to manage ongoing and ad hoc income online as well. And at the same time, we've brought out a new email notification process which will inform IFAs when the balance is running low or whether there isn't sufficient cash to meet the next income payment. And it will give you enough time to come on, make the necessary arrangements so that isn't missed. Finally, we have added a money out overview page for all of the clients that you look after who are in drawdown. That's on the V2 section, and that will contain all the important information which you may need, including LTA which has been used, beneficiaries which have been set up, a current fund split between crystallized and uncrystallized, and on that part of the website, that's where you can manage the income drawdown. Just moving on, we've got a good regional cover. I appreciate a lot of you may be up and down the country, so we've got a good regional cover of different BDMs. I'll leave that up for a second. I cover the South East North area, which consists of the City of London, Hertfordshire and Essex as well. I'd now like to hand over to our Head of Investment Management, Matthew Brennan. Matthew will spend the next half hour assessing the turbulent year we've seen, and he'll look at the number of factors to determine how it's possible to generate an attractive, sustainable income for retirement without taking excessive risk. Matthew, over to you.
Hello everyone, and thanks for taking the time to come and join this presentation today. So my name's Matt Brennan. I'm Head of Investment Management at AJ Bell. That includes running a range of portfolios, including income portfolios. So hopefully I'm qualified to speak about today's subject. So today we're going to be covering the topic of generating sustainable income in retirement. So everyone has probably heard about the 4% rule. This idea of 4% is a safe amount to take in retirement. So before we actually start about talking about how we generate a sustainable income, I just want to give a bit of a background as to why we're looking at 4%. What does that mean, and does it have to be income, or can it be done in different ways? So people like to say investment doesn't have to be rocket science. However, in this case, it kind of is. So a guy called William Bengen, who actually qualified from MIT as a rocket scientist, went on to work for his family business, and then finally became a financial advisor, was the guy who originally did the work around, kind of how much you should be able to take out of your portfolio each year for it to be able to last the course of your retirement. So the magic number that you can take out of your portfolio each year and grow with inflation was deemed to be 4%. And the reason 4% was chosen was looking at all historical returns all the way back from 1900 until obviously at the time of him doing this study, which was 1994, and looking at not just the average level of return, but what order those returns happened in. So, for example, if you invested just before something like the Second World War, where returns were very low for a period in the early 40s, then obviously you're going to get off to a bad start, but then the markets might do better later on. Vice versa, you might link right at the beginning of a good period, the 60s, for example, where you build up your pot, and then even if there are losses further down the line, they don't matter because you've grown your value. So what this piece of research did was it said that actually looking at all history through the 20th century, there was a really, really good chance that if you took 4% out of your portfolios each year, that it would last the course. So here we've got a couple of examples. So if we take 2 years in history, so 1906 and 1923, the total return of these portfolios was actually almost identical. You can see over the period of time on the graph, you can see that actually the ending point is almost identical. But you can see in 1906, your portfolio got off to sort of a bad start and then recovered, whereas obviously in 1923, it was a better start. However, if instead of taking 4% each year, instead you took £5,000, so 5% each year, you can see that whilst you're taking more money in those early years when the market's going down, that actually there's almost this kind of escape velocity where you've almost spent too much money. And this risk is something called sequencing risk. So what we're seeing here is that the magic number tends to be around 4%. And we've seen that even though this was, as I say, original work was done in 1994 by William Bengen, it's been retested, across areas such as, the dot-com bubble, and obviously we've got early signs of what happened in the global financial crisis and even during COVID, that it still holds, that the markets do tend to recover quickly, but if you do spend too much money when markets have fallen, then you're in trouble. And really this slide helps to, I guess, provide the basis behind that. So what we tend to see with financial markets is that when they're going up, they go up slowly and steadily over a number of years. Whereas what we can see with bear markets, when markets fall, it actually tends to be the opposite. There tends to be this short, sharp fall, but actually it doesn't last that long. So the idea behind the 4% rule is you're not taking too much money out of your portfolios when the markets are down, and usually that short, sharp recovery, that actually means that things get back to normal before you know it, and actually you can then return to that. So I guess that's probably the interesting thing about the research from William Bengen is people focus on the 4% rule. The bit that people probably don't focus on so much is that he also said that your portfolio should actually carry between 50 and 75% in equities. And this is that idea is it's not about risk in the traditional sense that you should be holding lots of bonds. You still need to hold equities because that's what's going to grow in the long term and fund your retirement. But actually it's not the quantity of equities that matter, it's the amount of money that you take out of the portfolio. I think another interesting point that we're going to get onto today is the 4% rule is about the withdrawal from your portfolio. And again, people use that interchangeably about 4% income. At no point during the research is there a requirement that 4% has to come through income. It could be a combination of income, it could be capital gains, or it could be from taking from cash. So I guess the idea behind a 4% income is almost that kind of natural way of getting that 4% withdrawal, but at no point does the research show that that has to be an income-based return. Instead, it's a combination of capital and income that can be taken from the portfolio. So just wanted to actually talk a little bit more around that actually. So as I say, kind of when it comes to retirement, the idea of an income strategy is quite a popular one. Now, there's some stuff you could point to, and I was recently looking at some data from MSCI around the characteristics of high yielding equities, and that actually if you buy the right type of high yielding equities, that can actually have a lower risk portfolio. So we'll touch on that later, but if we put that aside and look at I guess income returns versus say capital gains, there is perhaps 2 or 3 reasons why getting your returns through income can actually be beneficial compared to selling down gains you've had. So first of all, and one of the most obvious is taxes. So obviously I'm not a tax advisor, but as you know, and in particular in the UK, income on dividends is charged in a different way from capital gains. So there may be situations where it's better to receive income versus capital. So depending on kind of what earning bracket you're in, depending on what tax wrappers you're using, and again where you're based, how you're going to spend that money. So sometimes actually, sometimes income's better, sometimes capital's better, but certainly that could be a reason why people would be looking at income returns. I guess the second point is both timing and an operational point of view. So obviously one of the nice things about the income coming off a portfolio is that actually it's almost a fire and forget solution. So if you can have an income coming off that matches the spending needs, so somewhere around 4%, then actually from an advisor point of view, it makes life a little bit easier. You're not having to constantly go into that portfolio, sell investments down. It means that there's always going to be income there and it's going to be topped up, so you're never going to forget. And I guess even things like during, say, COVID-19, if you look at what happened in the markets, there was a 1-month period where, from February to April, where the markets fell by about 20%. So during that very short, sharp period, you probably don't want to be selling down sorts of positions. Obviously, if you're getting a natural income during that point, that's good. Obviously, by the end of 2020, we actually saw financial markets up 20%. So I guess the point is, usually it doesn't matter, but there can be specific circumstances where getting that income from a timing point of view and making sure it's there is important. And then, as I said, the final point is, when you get your income from your portfolio, that naturally comes off, it tops up your cash and you're not having to do anything. Whereas if you're selling down, in certain markets, you have to pay transaction taxes. So if you're selling any, for example, Indian shares, so you've got any emerging market funds, then you're paying transaction charges when you sell those down. Similarly in the UK, if you're then having to top up holdings because of rebalancing, so if you're having to top up UK equities, you're paying stamp duty or SDTR. So again, having that natural income stream does allow you to not have to touch that portfolio as much. So I'm very much an advocate of focusing on total returns, not income, and selling down. But I also do see why an income strategy can make life easier. And if you can get a substantial portion of that 4% through income, then it does mean there's going to be less interaction with the portfolio, less risk of selling at bad times, less chance of forgetting, and so on. So I guess kind of one of the things we've seen first of all is I guess kind of the 4% rule was done, as I say, back in 1994. I wanted to talk about, I guess, is it still valid? Should we still be thinking about the 4% rule? Because obviously, that's almost 30 years ago. A lot has changed. So I think if you look at the period when the analysis was done, the average real return, so the average return after adjusting from inflation from 1900 to 1994 was about 5%. If we look at current valuations, we can see that your real return of a balanced portfolio, so 50% equities, 50% bonds, is actually going to be closer to about 3%. So it is less than historically on average. However, the important point again is if you look through history, there was certainly points when real returns were less than 3%. So again, if you take the 1970s, when we saw hyperinflation, we were seeing long periods of negative real returns. So we're certainly in an environment where earnings yields, and earnings yields is obviously the profits of a company divided by share price, almost how much you're paying for the current earnings of a company, have fallen a little bit over the last sort of 12 years, but not substantially. So really what I'm saying here is we can never say history is going to be a predictor of the future, but we can certainly say certainly from an equity point of view, from a share price point of view, there's nothing that's happened in any of the major markets that really change that kind of history of I guess earnings yields. And I remember earnings yields are different to dividend yields. Earnings yields are total profits, whereas dividend yields are how much I paid out. I think that's the bigger point, is that over the years, the dividend yields, and certainly we can see here the blue line for the USA, have come down, and this is obviously as regions like the US have decided to favour share buybacks rather than paying out dividends. And again, that actually goes back to my point of the taxation regime, is there is benefits in the US for doing buybacks rather than paying out dividends. Whereas if you look at the UK, you can see actually, other than that sort of I guess initial sharp fall in 2009, the dividend rate in the UK has actually stayed fairly flat. Now, what this has meant is if you look at income portfolios, and certainly ones that are chasing a yield of 4% plus, that they're much more biased towards UK stocks and European stocks. This does cause a problem if you're really trying to get that 4% yield. So as I touched on, there's been some really interesting sort of I guess research come out from MSCI recently on equities and what happened during COVID-19. So again, if we focus on that period, February to April 2020, we saw just over 10% of companies in the MSCI All Country World Index cancel their dividends altogether. So obviously quite a big proportion. Now, if we focus on the MSCI World, which is the developed part of that market, 2/3 of the cuts came across just 3 countries, and that was the UK, France, and Germany. So again, if your portfolio was biased towards any of those countries, you're going to be hit much harder. Similarly, from a sector point of view, and we'll get onto this later, 3 sectors, so basically diversified financials, consumer discretionary, and materials, accounted for over half of the dividend cuts. So again, it kind of shows that different sectors were hit in different ways, and almost the nature of the market over the last decade has maybe pushed people into different sectors, into different regions. Now, as I say, you can still, if you look at here, if you've got the Europe and the UK up at 4%, and you've got the US down at 2%, somewhere like 3% is still possible. But getting that number closer to 4%, almost by design, you're going to have to end up pushing into some of these different regions. So again, looking at what happened during COVID-19, the MSCI World, the dividend yield of the MSCI World Index fell by almost 10%, so from 2.7 to 2.4% in just 2 months. So again, if you look at the research as to what's possible without still avoiding yield traps, the research shows that actually you can probably achieve a yield of about 1 or 2% above so I guess a broad index. So if the equity index is yielding about 2%, then you can probably achieve about 3 or 4% without taking excess risk. But once you start going beyond 4%, then you're suddenly buying what's known as a yield trap. And when you buy yield traps, they're companies that are, you know, the payout ratio is far too high, so they're paying out more than they're earning in profits. That the share price has slumped, and that's the reason the dividend yield is high. So, you know, a poor performing company, or as you say, they're biased into certain areas or certain regions. I think the other thing that we should acknowledge is over the last decade, the changing nature of the bond market. So again, I'll just circle back to that point. Actually, the research shows that for retirement portfolios, actually you should have about 75% in equities anyway. But I guess that's been exasperated over the last 12 years where bond yields have fallen substantially. So here we're looking at the option adjusted spread. So this is the extra return you get for corporate bonds over government bonds. So again, historically, you know, that'd be 2-3%. So, you know, you're definitely being rewarded for holding corporate bonds, for example. We can see now that's squeezed so low, obviously driven by factors such as quantitative easing and the buying programs of central banks. So now you're getting so little extra yield over government bonds that actually it does push you more towards equities rather than bonds. And again, that's not to say bonds shouldn't be part of your portfolio, but again, it should make you really push that question as to, yes, I'm going to take 4% out of my portfolio, but should I be doing that through just income, or should I be looking at somewhere between 3% in income and then topping that up by selling down some of my winners in terms of capital gains? So this was obviously the earlier point I made, is again, not all sectors are created equal when it comes to sort of dividend payouts. So we're looking back at equities here. You can see almost those established sort of slow growing sectors such as energy, utilities, materials, for example, which have been around for a number of years, paying good dividends, are the ones that are still paying good yields. The interesting one here is financials, because that was at the top, you know, a year ago, but has fallen substantially. So again, if you take a yield first approach to building your portfolio, you're going to end up with a very unbalanced portfolio. So if we look at the right hand side, you can see the lowest yielding sector is technology. And obviously, if we look at what's happened over the last 3 years, the technology sector has returned over 100%. So you're missing out on a lot of what's driven the stock market over the last few years if you're ignoring those sectors. So again, when building a portfolio, either using an active approach, so using active funds, or using, I guess, what we call an index approach. So there's ETFs out there that are tracing income. What we make sure is that those ETFs are sector neutral. So we make sure that they're still buying technology stocks. You know, it's not going to deliver as high a yield, but you know, the higher yielding technology stocks are in there equally. Having the higher yielding, say, consumer staples in there as well, and then obviously at the other end, the energy companies. So as you say, if you just take that approach of trying to get to that 4% level, you can see you can do it, but you're going to be so biased, and your returns are going to be so different to that typical investor's portfolio. Now, what I would like to point people to is this is probably what I'd call the dark arts, and this is when we look at income in portfolios, people just look at the underlying dividends that are being paid by the companies. Now, if you're buying your if you're buying an MPS or a fund, actually the income you get doesn't actually necessarily match what the underlying dividends are of the company. So let me give you a few examples here. So say you buy an equity fund and it pays the underlying companies pay 4% dividends. Now, what you might find is you might find things like certain fund fees are being taken away from your income. Different countries treat income differently, and that's certainly true when it comes to bonds. So I've got a great example on the next stage of that. So depending where your fund is based can really depend on how much that income can be paid out. And again, if funds are doing things like lending out your portfolio, any money they earn from lending out your portfolio can also be distributed as income. And then the final point sort of mentioned here is things like you see things like Schroeder Income Maximizer, where you can write derivative strategies, you can buy call options, sell options, write puts, for example, on your portfolio, and again that can all be paid out as income. So I think people forget about this, but I think hopefully the next example on the next slide really brings to light how important it is, and in particular in the bond world, because what happens is, depending on where your fund that you're buying is based, changes the treatment of the income that can be paid out on bonds. Now, I think the risk warning I want to put here is, if a bond fund is paying out a 3% income and yields are 1%, then it's going to make a capital loss. You're basically exchanging income for capital. But as part of a diversified portfolio, that can be a really good thing, because if you can still get 2 or 3% on your bond element of your portfolio, it stops you having to push your risk out quite so far on the equity side, because then you're not having to buy just energy companies and utility companies, and actually you can still have a good balance, a good broad spectrum of equities. So the bit you've been waiting for, I'm sure with bated breath. So here we've got 2 ETFs. So both ETFs here track the exact same index. So they both track the FTSE conventional 0 to 5 year gilt index. So exactly the same bonds, same strategy. And you can see from a total return point of view, again, returns have been identical. So obviously in the current environment where bond yields have gone up a little bit, then this has seen a modest total return, a modest total return loss over the last 12 months of minus 0.7. Now, the iShares product is domiciled in Ireland, and therefore follows IFSD financial regulations, an accounting regulation, whereas the Lixor product is domiciled in Luxembourg. It's a French company, they tend to be domiciled in Luxembourg, and therefore it follows something different, something called Luxembourg GAAP. Now, what this means is the Irish ones can only pay out the yield to maturity, which is not the coupon rate. It's basically kind of the coupon minus any capital losses you're expected to see on the bond over the remaining life. Whereas the Luxembourg one is actually able to pay out the full coupon amount every year. So you can see here that the iShares product is giving you a 0.4% income return, whereas the Lixor product is giving a 1.9. Now, that's quite a technical point, and I wouldn't expect everyone to go out and start reading about accounting regulations. But what I'm saying here is the important thing when you're building these income portfolios, and when you're building an income portfolio, is yes, look at the companies you're buying, but it's really important to look at the vehicle you're buying and how much income it's able to pay out, because that really allows you to still build a fairly balanced income seeking portfolio without having to take unbalanced risks. Now, as you say, the Lixor ETF here is obviously going to have his capital returns, going to be 1.5% worse than the iShares one over the last 12 months. But as you say, at that point, then you are able to buy your traditional ETFs tracking Apple and Amazon and all the likes, where you're still seeing those good gains from elsewhere. So something that I thought might be useful to bring onto the radar and maybe again sort of completes the circle in terms of what I was talking about in terms of I guess capital gains versus income and the way you should think about these things, is that again HMRC have recently launched a consultation or a call for input in looking to what funds can do and how they can distribute income. So back to almost that previous example of, do we make this more of a regular thing where even if a fund is only generating 2%, can it actually just pay out 4% every year, making advisors jobs easier. You know, that can be a mix of capital and income. It would mean that you don't have to worry about, as I say, different taxation regimes, wondering about how different things are treated. So this is a very recent development that HMRC have put out, this call for input. But I just thought it was really useful to see this, that even from that kind of government point of view, starting to look at trying to stop people thinking about income and capital gains separately and more thinking about that total return, but obviously giving advisors the ability to still sort of get that 4% without too much hassle. So really, that's the meat of kind of what I wanted to talk about today. And I guess it was perhaps a little bit woolly in places. So I just want to maybe clarify some of the key points there. So I think, first of all, 4% as a sustainable amount is nothing to do with what equities are yielding or what's happening. It's really based on history in terms of what's happened in the market in the past, and making sure that your pot can last the full 30 years, 50 years, however long you need for retirement. And that 4% rate is the magic number historically, in the fact that I think, apart from one or two times, a couple of examples where it would have lasted the full course. So I think that's the important point, that the 4% is based on that, and it's nothing to do with dividend yield. And as I mentioned, there's nothing in there that says it has to be from income. It could be from capital. But as I touched on, you know, I can see why you'd want as much of that from income potentially. Personally, the two funds we run at AJ Bell, the Income and Growth Fund, that both at the moment distributing around 3 to 3.5%. So long run, again, we target around 4, but in the current environment, we look at about 3 to 3.5%. Not quite to the 4% level, but that's obviously going to generate a good portion of that 4%. But again, we don't push that for at the moment because it's tough. Instead, we're hoping that you know, short-term capital gains offset that. Does history bear any relevance today? You know, obviously, I've got no crystal ball, but certainly from what I can see from a valuation point of view, there's nothing that dispels all that historical research for me. So people are brought into question that 4% withdrawal rate. I personally still think it holds. Again, just the focus should be on how you take that withdrawal, not necessarily just through income, but through income and a combination of capital. For an investor, there always needs to be a trade-off between those capital gains and income returns. You know, there's ways of mitigating that I've obviously touched on in terms of the fund structure or where that's based. But certainly, given the changing nature of, for example, how what happens in the US. So in the US, as you say, very low yields versus what happens in Europe, where there's high yields. I think you've got to still make sure you build a diversified portfolio. Still make sure you've got good weighting in the US, Asia, EM, where yields are slightly lower. You know, maybe you can be slightly biased towards the UK, Europe. But really think about making your portfolio work as hard as possible through fund structure, through domicile, through stock lending, through anything else you want to do. Do all those things first before you start sort of putting big biases into your portfolio. And as I say, one for the radar, early signs of seeing action from the UK government, which actually might make life easier to stop having to worry about income versus capital. Because obviously there'll be fund structures where that's able to do that without having to worry about it. Now, as I touched on, there is some empirical research that taking a high-yielding strategy can protect slightly. I guess if you look at the MSCI World since 2000, about 50% of the returns have come from dividends, and obviously a bird in the hand is two in the bush and all that. So there is some research that can help, but personally, I think you should try and be fairly agnostic on income versus capital gains and really focus on total returns. But that doesn't mean that, as you say, you can't sort of still push yourself up towards that 3% mark. And And I'd just like to mention, one product we do have at AJ Bell, we do have our retirement portfolio solution. That's really been designed around the sort of Bengen's work. So the way we've designed this is it's a portfolio that it's got a total equity content of around 68%. So somewhere in between that 50 and 75% mark mentioned as the optimal amount. Obviously, we're generating at the moment an income yield of about 3%, so slightly below the 4% at the moment, but obviously over time we will get there. One of the important elements I've not mentioned today is it also holds 10% in cash, and that's actually an important point. So if you're only getting 3% off your portfolio, if you've got a 10% cash buffer, that's actually going to allow you to make up for that income shortfall for 5, 6, 7, 8 years without having to touch the portfolio. So I'd invite you to have a look at that, and if you'd like some further information, happy to give you some information on that. And then the final word of warning is all this analysis is done before fees. So if you're looking at that 4% yield, remember to the end client, that's probably actually going to be close to 3% once you've taken off advisor fees, platform fees. So really when you're sort of looking at the retirement and safe withdrawal rates, it's actually somewhere close to 3% net at the moment versus 4%. So as I say, a challenging environment given where bond yields are, but we still think it's possible. Do it in a balanced way. There's no magic, secret piece of magic. The only magic I ever can think of is, as I say, is really that fund structure point where you can have the exact same sort of companies and pay different amounts. But other than that, it is still really about diversification, being well balanced, looking for those sort of those safer dividends, and really focusing on equities versus bonds. Thank you very much for taking the time to listen today. Hope you learned something. There's a few tidbits in there, and speak to you all soon. Thank you very much.
Thank you for that, Matthew. If anybody has any questions following that session, please either send them over on the chat function or note them on your feedback at the end of the session, and we'll come back to you promptly. Next up is Jupiter Asset Management's Investment Director, Alastair Irvine. Today, Alastair will guide you through the markets in 2021. He'll take a look at the post-peak COVID recovery and dig into the outlook for the macroeconomic backdrop for the second half of the year, focusing on the potential for rising inflation, the appetite for inflation, and the other options to the central banks. I'm pleased to welcome today Alastair Irvine.
Hello, my name's Alastair Irvine. I'm the Investment Director for the Jupiter Merlin Independent Funds team. And today we're going to talk about inflation and in the context of investing for retirement. And of course, this is a significant subject in the market at the moment. The Jupiter Merlin Independent Funds team has been around for quite some time now. And in fact, John Chatfield Roberts and Algie Smith Maxwell, who you can both see on the photograph there, they joined Jupiter 20 years ago now, but they've been running fund of funds sometime before that. So this really has a very long pedigree. But enough about us. Let's get to the meat of the presentation now. We're going to look in some detail at what is really driving the markets at the moment, particularly the economic cycle. We're going to talk a bit about central banks because they're key to what's going on behind inflation. We're going to talk a little bit about the vaccine, but not a huge amount. And we're also going to look at bond yields because that is how the markets measure the risk of future inflation and other effects as well. Just in terms of the vaccine, there is nothing that I can tell you that you don't already know. I can't add any great value to you about that. But of course, it is against the backdrop of COVID-19 that a lot of what I'm about to talk about relates, and the extraordinary decline in economic fortunes during the course of last year as what was a relatively contained event in China then spread abroad, particularly through Iran and Italy, and then within a very short space of time had become a pandemic. As we move now towards the, not the post-COVID era, because there won't be a post-COVID era, we've only managed to eradicate smallpox using inoculations. It is how we move into this new era of living with the virus and all the economic and social ramifications that come with that. Now, it doesn't need me to tell you that the amount of stimulus that has been tipped into the economy over the past 17 months has been prodigious, not least when the Western democracies started to go into lockdown in February and March of last year. There was a sort of contract, if you like, between governments and their electorates, that on the basis that electorates were going to be locked up in order to protect their lives, the quid pro quo was that governments were going to have to support their livelihoods in the meantime. And of course, you saw the inception of a large variety and number of lifeboat and lifebelt schemes, ranging from furlough schemes to business support schemes to the EU's 750 billion euro loans and grants scheme, which, although it was negotiated 12 months ago now, is only starting to disperse its first funds this month. It's taken a whole 12 months to get there. But if there's a big difference between the global financial crisis, when it was largely the central banks who were doing the heavy lifting, and the pandemic crisis, it is the massive government interventions. So central banks, although they were quite late to realize what was going on last year, once they finally got their act together, they really cranked up the QE, quantitative easing, that's their bond purchasing programs to provide liquidity to markets. And of course, they dumped interest rates right down to pretty well rock bottom, and they've been there ever since. But in the meantime, those initiatives that I was talking about amongst governments have really come to the fore. And of course, in a number of situations, governments have used these stimulus packages as a sort of carrot and stick to sensitive industries, particularly those involved with climate change, so things like airlines, aircraft manufacturers, things like that, automobiles, specifically to tie in the financial help with the greening of the economy. So one of the effects of COVID-19 has been to rapidly accelerate the progress towards the decarbonisation of the economy. Don't take these numbers for granted. They are a bit of a shifting feast, but they give just a very good idea of how much is being shoveled into the economy right now. If we're just looking at the economic prospects, and here we're showing this through some charts called the Purchasing Managers Indices. These are not hard economic data. These are surveys that are taken of businesses regularly, normally once a month, by economists, where they go out and ask about business prospects in terms of order books, the visibility of order books, future pricing, raw material prices, what's happening in labour markets, and they come out with this confidence index. And if the figure is above 50, then that tends to be economically expansionary. And if the figure is below 50, then you're heading off into, to use an analogy from Winnie the Pooh, Eeyore's dark and gloomy place, and it's all full of thistles. You can see last year that economies absolutely fell off a cliff during the second quarter, in some cases in the first quarter, and these numbers, the term unprecedented is used hyperbolically and in a hackneyed fashion. But when you use unprecedented in the context of what happened to the economy in the first half of last year, you can use it pretty genuinely. These are events that for most economies have not been seen in more than 300 years. So, you know, the US shrank by 3.5% last year. We fell by nearest damn it 10%, 9.9. The Eurozone fell by about 7. Japan fell by about 3. These are extraordinary numbers. And what we've seen over the course of the past 7 or 8 months, and particularly tied in with the timing of the vaccine announcements, those vaccine trials being successfully passed through in November of last year, and then suddenly coming along like a fleet of number 38 buses. What that did was to mark a pathway beyond COVID from an economic perspective to allow you to see a future beyond it. And of course, that coincided pretty well with the end of the calendar year of 2020. So we have now started to see quite a strong rebound in economic growth. And here, of course, you do rather have to distinguish between what is recovery and what is genuine growth, because what we're seeing at the moment is very definitely recovery. Longer term growth depends on many factors, but one of the things that markets are speculating on at the moment is that when we get through this recovery phase, which may last 1 or 2 years, it is what rate of growth does the global economy and indeed national economies settle down at as we move towards 2025 and beyond towards 2030. Will we effectively resume where we were in the pre-pandemic era, where the US was averaging about 2%, the UK was about 1.5%, the Eurozone was somewhere between 1 and 1.5%, or will various factors, particularly those relating to societal change, behavioral change, but also this great big elephant in the room about the decarbonisation of the economy and all of those stimuli packages that I was referring to earlier, will that change the pattern of future economic growth and move it into a different era? If we're just looking at how long it's going to take for economies to get back to where they were at the end of 2019, of course, during the course of last year, when we saw this significant decline in economic prosperity, numbers were being bandied around between 2 and 4 years as to that recovery time before we get back to where we were at the end of 2019. For the US economy, which only 3.5% decline last year, is still extraordinary by any measure, even though it was only a third of how far the UK fell. Nevertheless, what we saw in nominal terms, in dollar terms, was that by the end of March, the end of Q1 2021, the US economy was already bigger than it was in December 2019. It had got up to about $22.2 trillion against about 21.7. So already it has recovered to where it was before. And indeed, the interesting thing is, and this feeds in later into the discussion about inflation, is that it's actually done that with a much higher level of unemployment than was the case at the back end of 2019. Then US unemployment was about 3.7, 3.8%. In the first quarter of this year, it was averaging about 5.6%. What that implies is that either there has been a significant improvement over the past 18 months in terms of US productivity, or indeed that while there might have been a lot of people employed at the end of 2019, a fair number of them were working at a subpar rate in terms of economic output. Now, of course, the one element in this which we haven't discussed, which is really important, is China. Part of the difficulty with things like PMIs is that China doesn't produce that kind of data. But here on this chart, you can see the role that China plays and its increasing role over the course of the last 40 odd years as the economy has significantly accelerated. You can see that the US is still roughly a quarter of the global GDP. Europe, as measured by the Eurozone, has been in slow decline in relative terms. We in India share at about 4.5%, but it's that rise in China. If you go back to December 1979, the Chinese and the Indian economies were the same size. Now China is accounting for somewhere around about 18% of global GDP. And of course, it was the genesis of the pandemic in the first quarter of last year, but it was very contained. You can do that when you're under an authoritarian communist regime, as China is, in terms of controlling population movement and containing the virus. So although they had a very difficult first quarter last year economically, in terms of major economies, major global economies, they were about the only one in 2020 that actually produced a positive result. They actually grew last year. And if we're looking at the prospects for this year, if the US economy is going to grow somewhere around about 7 to 8%, again, an extraordinary number. The UK is potentially going to grow at about 8%. China, you could find any numbers at the moment between the government's official forecast of somewhere around about 6.5% to credible forecasts from credible economists at around 10%. And, you know, we are talking about something that is the size of nearly a fifth of global GDP here. Now, where this all fits in with inflation is sort of broadly illustrated on this slide. Here we're looking at developed world inflation rates, and there is a dotted line going there across the 2% level, because 2% is the common thread running across the mandates of the Bank of England, the European Central Bank, the Bank of Japan, and the Federal Reserve in the United States. That 2% inflation target is a common theme across those economic growth areas. And for most of the last 30 years, there have been disinflationary pressures. That's to say that the rate of inflation has been declining. And since the inception of QE as part of the sort of rescue mission after the global financial crisis, there have been strong deflationary pressures. In other words, trying to drag prices down. And you can see that for a large chunk of the last decade, trying to get to that 2% inflation target, which sort of greases the wheels of economic prosperity, allows you to feel as though you're actually making progress. Some of those regions have really been struggling to trouble the scorers. But you can see over the course of the last 3 or 4 months that there has been a notable uptick in inflationary pressure. There is no coincidence that that ties in with the inception of the vaccine programs and this pathway to economies reopening after the prolonged period of constraint during the major part of the pandemic last year. And of course, as you start to recover, it creates additional complications and demands on things like supply chains and raw material prices, and it creates instability in some of these areas. So we've been seeing significant spikes in raw material prices, particularly in the first quarter, as measured by things like copper, and steel, and iron ore, cement. But more latterly, partly because of the distortions created by things like the furlough schemes, you've also seen disruption in labour markets. So what you've now started to see is a level of inflation feeding through, and you can see here for the United States, this is core inflation here in this grey line. The US defines that by removing volatile food and fuel prices. I'm never quite sure why. because regardless of how volatile they are, we still buy food and fuel, regardless of whether they're going up or down. But nevertheless, you can see there that that core inflation rate was about 4.7%. Their headline rate of CPI, the Consumer Price Index, was 5.4, and that's measured against that target of 2%. Here in the UK, you've seen the latest June data coming out at 2.5%, and bearing in mind that back in January, inflation was 0.4%, you can see that there is momentum behind that. And this is true around the Western world at the moment, and indeed China. The big question is this a transitory effect? Is it just a short-term blip before we sort of resume these long-term patterns that you can see on the chart there, or is there something additional at work? And this is where all those debates about those stimuli, those packages that are being put in by both central banks and governments start to come into play. And I think one of the key things that we need to look at as a future indicator of whether we're about to embark on a new period of structurally embedded inflation or whether it is transitory is what's happening to the labour markets, particularly because as wages start to rise and the expectations of rising wages become embedded, so that then feeds on into higher business costs through employment costs, and it leads to a general inflationary environment. Of course, complicating all this in the United States in particular is a change of government. The Biden government is very definitely left of centre. In fact, it's probably the most socialist government that the US has ever had. And there is a huge program of social and economic reform underway. It is constrained by the numbers in the Senate and in the House of Representatives as to how successful Joe Biden will be in getting this through. But again, there is a strong body of feeling that these measures in themselves could be inflationary, particularly things like doubling the minimum wage from $7.50 an hour to $15 an hour, repealing a whole raft of union laws or anti-union laws, more accurately, allowing and encouraging collective wage bargaining, also putting in huge costs for the levelling up of education and healthcare services, all of which is going to be paid for through higher taxation. And then, of course, we have these huge, big global macro effects, which are also affecting the outlook for inflation, particularly as we've seen over the past 20 years, the accelerating digitization of the economy, which is inherently deflationary because of all the disruptive elements that it does to business and pricing. But on the other hand, the likelihood, or the possibility at any rate, that the decarbonization of the economy, which is really only just in its infancy, but has a date stamp on the end of it, as measured by the Paris Climate Accord of 2050, that is likely to be inflationary. What I can't tell you is which of those big, powerful opposing forces is going to have the upper hand in all of this. Maybe they cancel each other out, and you end up with another chart that looks a bit like the one that you can see now. Or maybe it is that the decarbonization element overcomes the deflationary element of digitization, or maybe it's the other way around. I simply don't know. And I don't think anybody else knows either, because none of us has ever been here before. This is very new for all of us, regardless of how long you've been in your professional career. And I've been doing this for 36 years, and I have never seen any of this. I've seen elements of it, but I haven't seen it all in its totality. Now, how do the markets react to this? Well, as inflation has come down over the course of the last 30 odd years, and you've seen these disinflationary pressures, so interest rates have come down, and of course there is a very strong correlation between sovereign bond yields and national base rates. That's been exacerbated over the course of the last 10 years, particularly by this whole process of QE since the global financial crisis. This is the central bank process of purchasing bonds in order to try and get liquidity into the system and to stimulate some inflation and some economic growth. In fact, you could argue that QE and ultra low interest rates actually do the opposite from that, in that they allow companies which would have otherwise gone bust to access financing markets, particularly through bonds, at rates which would have been inconceivable before, and it sort of perpetuates what you might call a zombie economy, which leads to surplus labor, surplus output, and surplus capital, and itself creates deflationary pressures. But if bond yields had been driven down to pretty well rock bottom, so there has been a slight turning in that curve more recently, and this is to do with the expectations of the markets that potentially there is inflation which may become embedded, or indeed it may not. But what markets have been doing is simply hedging their bets that it may be. Of course, there is a great big game of bluff here being played between the markets and the central banks, not least because the process of QE has led to asset price inflation. It is that the markets themselves now almost rely on QE to keep those asset prices high. So at various different points in the cycle, the central banks, through their process of forward guidance, of leading the markets as to future behaviors of what the central banks are likely to do in terms of policy, and the markets themselves moving bond yields to try and lead the central banks to a different place, is all playing out in front of us. Of course, one of the things that is the huge elephant in the room here is that as governments have been piling on the coals with these huge fiscal packages, and the central banks have too, so the amount of debt that is sloshing around the system has just gone off the scale. Most of the major economies in the West now have debt to GDP ratios in excess of 100%. In other words, the amount of debt that they're sitting on is bigger than their economies. The question is, if there were to be a sustained period of inflation that required reaction from the central banks to try and rein that inflation in before it starts running away, and using interest rates to do that, the question is, if that debt has not come down, how much can we afford in terms of that additional burden of financing cost before the whole system just simply collapses in on itself? And those of you who've been keeping a beady eye on the financial press over the past 3 or 4 weeks or so will have seen that here in the UK, there is a real cost to this inflationary pressure. Just on that uplift in inflation that we've seen in the UK so far this year towards 2.5%, in terms of financing costs to that sovereign debt that has been accumulating on the national balance sheet, that now means that Rishi Sunak has to find another £10 billion this year in interest payments on the coupons on that debt. £10 billion, it's a big number. What would that buy you? That would buy you about 3 1/3 aircraft carriers. That's the way to look at these things. Forget about what billions are or trillions are. They almost become meaningless unless you put them in context of what you can actually buy with those billions or trillions of pounds or dollars. So this whole concept of debt affordability and how much we can afford to pay to cover the financing cost of this debt is another thing that needs to be weighed up in the whole conversation about inflation. Now, how do we apply all of this on the Jupiter Merlin team? We are running a range of unit trusts here in the UK. We've got some offshore CCAVs as well, but the principles are all the same. we are multi-asset global investors. We're investing across virtually all asset classes. We're investing across the world. But what we're really doing and really concentrating on is using fund of funds in order to achieve that end. And we believe that that unlike a number of our competitors, where empirically you're able to demonstrate that a lot of their performance attribution is derived from asset allocation, and a lot of that discussion that we've just been talking about on the macro side is what feeds into that. We, on the other hand, we tend to get the bulk of our attribution not from top-down asset allocation, but from that choice of manager, finding the right manager to do the job, and then putting the right amount of money with that manager at the right time, and then just letting them get on with it. So we spend an awful lot of time on manager selection, and then having chosen a manager to do that job, whether it's in equities or bonds, whether it's global, whether it's regional, whether it's national, then monitoring how they behave and looking for changes in performance which might be unexpected or out of kilter with their style of investment, and then constantly reviewing. We do in our portfolios. We believe quite strongly that although you have to have diversification in order to spread the risk, you need to have concentration amongst your key conviction funds, because that's actually where you get the performance from. So you would probably not be surprised to find when you're looking through the fact sheets of the Merlin portfolios to find that the top 5 holdings in any one portfolio might be anywhere between 50 and 70% of the total of that portfolio. We are very definitely active investors. The only way that you can beat your benchmark is by differentiating from it. So we have no intention of following a benchmark, otherwise you simply become a closet tracker. We invest in active managers, and we ourselves are active managers. And it's that differentiation from the benchmark which is how you derive the performance. And the philosophy of what we're trying to achieve here is really very simple. It is that in the good times we want to keep up with the markets, and in the bad times we want to lose less than they do. And across the range of the portfolios here, in order of risk, from the least risky Jupiter Merlin Conservative on the left to Jupiter Merlin Worldwide on the right, and the range of everything else in between. What this slide here is demonstrating is against each of their IA sector benchmarks, that the orange bar says that empirically, as markets are rising, as the sector average is rising, we're capturing, say for Merlin Conservative, 110% of that. In other words, we're outperforming by 10%. Equally, when the sector average is declining because markets are under pressure, we're losing less than those sector peers are at the same time. And if you do that fairly consistently, and you keep the orange bars bigger than the blue bars or the black bars, as we can see here, and you have that differential between the two in favor of orange, then that is what goes to the heart of compounding long-term wealth. If, on the other hand, you happen to invert them or swap them round, and blue becomes bigger than orange, then you're destroying wealth, and that's the point at which you should just pack up and go and live on a golf course. Now, moving into the pandemic at the beginning of last year, when we realized that COVID was going to be very different from SARS or MERS or bird flu, and it was actually going to be potentially an enduring event rather than just simply a short-term phenomenon that would fizzle out, our sole preoccupation was that of preserving capital to the extent that we were able to. We don't want all our managers, either in equities or in bonds, to be behaving the same way at the same time. And you know as well as I do that over the past 10 years or so, it has largely been been equities that are style growth, which have been in the ascendancy, if not dominant, over those that are more economically sensitive, that are style value. So at the beginning of last year, when we moved much more defensively, we were already well positioned, being in the range of 2/3, 1/3 in favor of growth in equities. But what we wanted to do was also to bolster the safety net. So we immediately doubled the amount of physical gold that we owned in the portfolios from about 5% to 10%. The reason for being 2/3 weighted in favor of growth and sticking with that at the beginning of last year was simply that they were the perceived COVID winners, the technology companies, the disruptors, but also the ones, companies like Unilever, that had underlying growth and sustainability to their businesses. We were just preoccupied with businesses which would come through this relatively intact. In November, though, when the vaccines came along, we knew then that potentially there was a game changer in operation here. What we had to work out was whether, as distinct from 2016 and 2018, when value had a brief period in the sun, but then only to fizzle out again, was whether the value rally that started at the beginning of November after the Pfizer-BioNTech announcement, whether potentially this was a game changer and this time that value rally actually had legs. We decided it did, but we also decided that the long-term growth story hadn't gone away. That is a secular trend that is there for the long term. So in wanting to balance up the two profiles of value and growth, we decided that we would not fund that by selling down some of our growth holdings. What we did was to book a stonking great profit out of our gold, and we reduced it from what was by then about 11% down to about 2%. And I'm pleased to say that on the basis of all the activity that we did during the course of last year, but particularly the ones in November, that we empirically we can demonstrate that had we not done that in November, each of the portfolios in terms of performance would have been about 3 percentage points behind where it is today. It just raises one more fundamental point about running fund of funds. Things happen slowly in fund of funds. It's not like investing directly into equities or directly into bonds. And you have to allow the performance to accrue. So part of the skill is knowing when you need to do something and then having the conviction actually to go and do it, as was the case in point last year. And if you took those two significant activity points of March and November, between them, we turned over about 40% of our total funds under management on the Merlin strategy, which is about the total assets under management on Merlin are about £7 billion. But if you went back to 2019, that illustrates the other side of running fund of funds, and that is knowing when you've laid out your stable and you're happy with it, then having the courage just to leave it alone. Don't meddle with it for the sake of being seen to do something. Don't confuse active, as in active share and differentiating away from the index, with activity and behaving a bit like a sort of demented blue bottle and rushing around and feeling that you need to do something because otherwise people will think that you're simply not paying attention. Having that courage just to leave them alone and allow that performance to accrue is really important. Otherwise, you build in two significant headwinds. One is that performance will not come through. And secondly, of course, you build in the frictional costs associated with dealing. Now, when it comes to investing for retirement, and I have to say this slide is way above my pay grade because this is very definitely in your sphere of expertise. De facto, the independent consultant has assessed a range of the Jupiter Merlin portfolios and deemed them to be entirely suitable for retirement investing based on sequential risk. So all I would suggest here is that you have a look at these funds, and if you have any questions on that, that you come back to your Jupiter sales representative, and they'll be more than happy to talk through the sustainability of fund investing, particularly with Jupiter Merlin, and how it's appropriate for what you're looking at. In terms of performance, over the year to date, the Jupiter Merlin portfolios are all in the top quartile, with the exception of Jupiter Merlin Worldwide, which is in the third quartile, albeit delivering in nominal terms pretty similar performance to the rest of them. And that is simply because it is in a much more aggressive sector, where there are many single strategy funds that can take much more risk than we are prepared to do. But if you look through that slide there, you can see the long-term trends of cumulative outperformance. So there we are. That's Jupiter Merlin, that's inflation, that's investing for retirement. Just in summary, our philosophy on Jupiter Merlin is that we want investors to get rich slowly. That's commensurate with whatever level of risk they're prepared to tolerate. We've been around for a very long time. We, as it says in the bottom right-hand corner there, we are flexible and forward-looking. We're not running a single strategy fund here. We are running an investment solution, a one-stop investment solution. We're not factor orientated. We're not slaves to the index. We want to beat the index. We want to outperform, and our track record suggests over the past 2 decades, in conditions of many varieties that we've seen thrown at us all the way through from the dot-com bubble in early 2000, all the way through the global financial crisis, right through to now with the pandemic, that being adaptable and reacting to inflection points is what really matters in that long-term compounding of wealth. Thank you very much.
Thank you, Alastair. Again, any questions for Alastair, please just note them on your feedback survey, which will automatically open at the end of the webinar, and we'll get those answered and back to you. So our final speaker of the day is our resident technical guru, Lisa Webster. Lisa is one of our senior technical consultants, and today she'll take you through some heavy content looking at a variety of potential lifetime allowance dilemmas, to be mindful of including the death benefit options available and how to pass funds on to beneficiaries in the most tax efficient manner. Ladies and gentlemen, Lisa Webster.
Hello and welcome to today's At Retirement special webinar. My name's Lisa Webster. I'm one of the senior technical consultants here at AJ Bell. In today's session, I'm going to be talking about lifetime allowance dilemmas and pension death benefits. So these are 2 topics that are not entirely unrelated. Quite often when you're making decisions for helping clients that have lifetime allowance problems, obviously they are more likely to have substantial death benefits, substantial funds left on their death. So what happens with those may be part of the decision in terms of how you manage the lifetime allowance as well. So on the agenda for today then, I have, first of all, we're going to have a little look at just the basics, a recap on the lifetime allowance, how it works, etc. Then I'm going to look at the age 75 dilemma. So this is the because we have this second test at age 75 on drawdown. So you have a test when it goes into drawdown, and then you have another test at age 75, whereas most benefits don't get tested twice, and so that causes some issues and some questions about how you should deal with that and what actions you should take. So we're going to have a little look at that, and then going to move on to death benefits. So again, just covering off the basics to start with, and then we're going to have a look at the specifics about beneficiaries, about what difference it means to be a beneficiary, what the options are, who can be beneficiaries, etc. And then I'm just going to finish off with a little look on inheritance tax and pensions and sort of circumstances when it can apply, and if so, what that looks like. So starting off then with the lifetime allowance basics. The lifetime allowance, put simply, is the amount of money that somebody can take from a pension, from their pensions, before this lifetime allowance charge, LTA charge, applies. And the pension funds are tested at certain points in times called benefit crystallization events, which I'll look at in a minute. But these are basically when you come to access benefits, and then there are a few other times, most obviously, say, mentioned at age 75, it can be on death, it can be on transfers to overseas schemes, etc. If at that point of time when the test takes place, the funds are above the available lifetime allowance, then we have this lifetime allowance charge on those excess funds. Lifetime allowance was first introduced back in 2006, back in A Day, and originally was for £1.5 million. And we knew at that point in time, with all pension simplification coming in, the lifetime allowance was actually set at that point in time for the first 5 years post 2006, and we can see it was going up nicely, and it went up to a maximum of £1.8 million. And so that was written in legislation at outset, that we knew what it was going to be for 5 years. Also written in legislation pre-A Day was the fact that the lifetime allowance could never go down. Obviously, we all know what's happened since then, and we all know that legislation can be changed, which is clearly what's happened in this case, because we've had several cuts over the years. Each time we have a new protection regime as well. So it was cut initially to 1.5 million, then 1.25, and then it went all the way down to £1 million. We have then had a couple of increases, which are just linked, because then it became linked to CPI from September in the year before. So we now have this amount of £1,073,100. And it was announced in the budget this year, but that is now frozen again for the next 5 years. So obviously, with it being frozen in monetary terms, that means in real terms that's actually a decrease. So obviously the lifetime allowance is a lot lower than it was ever intended to be at outset, and when the original pension simplification, the planning and the intention of policymakers at that time. So it's an awful lot lower now than they intended. It's been cut many times, and there's going to be more and more people that are going to be caught in it because of its being at such a low level. And I say over the next 5 years, with it being frozen, so an effective real terms cut, it's going to be more and more people that are dragged into it. So these lifetime allowance dilemmas that I'm going to come to look at, that's going to be impacting more and more people over the next few years, at least, looking at that. So that's where we are with it now. Those are the sort of levels that we are at. I do sometimes think, although obviously, it's good that it's increased from its lowest level of £1 million. It would have made the sums an awful lot easier had we had kept it at £1 million for the next few years. But we are where we are. So if you exceed it, then you have a lifetime allowance charge on the excess amount, and you can either take the excess out of your pension as a lump sum, in which case there is a flat 55% tax charge, which the scheme administrator would deduct that when they do the lifetime allowance test. They would deduct that sum and pay that directly over to HMRC, and then in the member's lifetime, and then the balance would be paid out to the member. Alternatively, it is a 25% tax charge is deducted from the fund when the test is carried out. And again, the scheme administrator would deduct that from the fund, pay it across to HMRC, but the balance would stay in the pension. So it could be used in the future, but obviously when you come to take that out of the pension, then you would be paying income tax on it. So if somebody exceeds the lifetime allowance and they are taking income, but they are still a basic rate taxpayer, that works out overall as a 40% effective rate of tax. That's because it's not just simply adding the 25% LTA charge and 20% income tax. You actually apply the LTA charge first. So if you had £100, you deduct £25, gives you £75, and then that's what's left in the pension fund. And then when you come to take that £75 out, that's what your 20% income tax is applied to. So that would be £15, and so you get out £60. So that's how you end up with an effective rate of tax of 40% for somebody who is over the lifetime allowance, taking the income out, but they're a basic rate taxpayer. So obviously for them, it's better than taking it as a lump sum. If you have somebody who's a higher rate taxpayer, which for people who have exceeded the lifetime allowance, then there might be quite a few people that fall into this category, then you apply the same principle. So you deduct your 25% LTA charge from your £100 to give you £75, and then you apply the 40% income tax to that, which is the £45. So yeah, that's an overall 55% effective rate. So that is the same as obviously taking it as a lump sum. So for a high rate taxpayer, it's neutral whether you're taking it out as a lump sum or taking it the LTA charge in the pension and then taking your income tax. And then finally, if you have your high rate taxpayers, then it works out as a 58.75% effective rate on that. So it's obviously designed that way that they think that most people who are over the LTA will be high rate taxpayers, so it's designed to be the same on that one. Obviously, if you do have clients that are north of the border, Scottish income rates of tax are different. So higher rate taxpayers, because they're paying 41% tax, would actually be slightly better off with the lump sum. Obviously, it's the same principle. Next up then, looking at the different benefit crystallization events and when these are tested. So these are the times when the lifetime allowance test is applied. We have, first of all, scheme pensions. So when you start taking the scheme pension, or these excessive increases. The next one down, taking other benefits, that's what we do most often, obviously, in our SIP world. So we have BCE 1, which is when you put funds, designate funds to drawdown. And then we have BCE 6, which is a lump sum payment, which could be either a PCLS or a UFPLS. Either of those come under that BCE 6. And then we have annuity purchase as well. Worth noting that they are separate events. So even if you have somebody who, so most commonly in our world, somebody takes their tax-free cash, their PCLS, and they designate funds to drawdown, even though that all happens on the same day, in practice, that is two separate benefit crystallization events. The way it works with the lifetime allowance, you always round down 2 decimal places. There are times when that can make just a little bit of difference. By the rounding down to separate events, you get a little tiny bit more on the lifetime allowance because the way the rounding works is they are separate events rather than having it as one as you would have under a UFPLS payment. Age 75, then we have these 3 different BCEs that can occur on the 75th birthday. So first of all, if they have any uncrystallised funds in a DB scheme, defined benefit scheme, any uncrystallised funds in a defined contributions, they have any uncrystallised funds in a SIP with us, and then this last one, this drawdown funds held. So this is where these are the same funds that get tested up here when you first go into drawdown, and if you still have drawdown funds at age 75, i.e. you've not annuitised or died previously, then you have this second test here, this BCE 5A, which I say I'm going to look at that in a little bit more detail in a minute. With the age 75, if people have, 2 or more of these, you can choose what order these BCE happen in. So obviously 75th birthday is a set date, but they may have different tranches. They may have different pension funds. They might have some DB benefits. They might have some DC benefits. If they're in different schemes, you can talk to the scheme administrators and say, like, which one you want to do first. Especially if somebody had some uncrystallised DB still, and then whether it was uncrystallised or drawdown funds which have grown, they have those as well. Because obviously, if you're going to breach the lifetime allowance, it's going to be the one that comes last or later that takes you over that allowance is the one where the lifetime allowance charge is going to be deducted. And so, you might want to think about which fund you want it to be deducted from. If you have got DB and DC, for a DB scheme, there will be an actuarial reduction in the pension benefits in the scheme pension that becomes payable because of taking into account the lifetime allowance charge. So you would need to get that information from the scheme as to what that reduction would be from the scheme actuary. Depending on what they use, it's probably more common for people to want it to come out of the DC to have the test on the DB side first, so you don't have a reduction of your scheme pension, and take the lifetime allowance charge from your DC funds, just because of the way it works. But obviously you need to look at the calculations on that if you had that circumstances. Death is the next category we have here. So if somebody died before age 75, then the uncrystallised funds, any uncrystallised funds which are then used for a beneficiary's drawdown, that's get tested. Any uncrystallised funds used to buy a beneficiary's annuity gets tested again. There's the 5C, 5D, or payment of a lump sum death benefits. That comes under there as well. Interestingly, so if you died before 75, it's only the uncrystallised funds that are tested here for drawdown. It's not your drawdown funds. If you die before 75, they don't get tested again. We then have a couple of ones at the bottom there. So if you transfer out to cure ops, then you gets tested as well. Basically, it means that it is unavoidable because you're either going to take benefits before you hit 75. You're going to reach age 75, or you're going to die before age 75, or you try and transfer out. Whatever happens, your funds are going to be tested. If you have a UK registered pension scheme, those funds are going to be tested against the lifetime allowance. It is unavoidable. Last one on there, it's a bit of a random one, BCE 9. It's not one that we use very often, but it's just to do with things like payment of arrears of pensions after death and lump sums based on pension errors, etc. So fairly uncommon, that one. So turning now to look at this age 75 dilemma. So this is around this second drawdown BCE. So as I've said already, the first benefit crystallization event happens when you put your funds into drawdown. They then get tested again at age 75. And basically it's the growth that's tested. So any growth in your investments, less any withdrawals you've made. So you are looking at the amount you've put into that you've got in that drawdown fund at age 75, less whatever was put into drawdown on the original benefit crystallization event. There is no revaluation of the funds or anything like that. So it doesn't matter, whether you put in your £500,000 or whatever it is into drawdown, on the 6th of April 2006, or if you did it yesterday, it would still be treated the same. It's just the monetary amount. And then each tranche of drawdown is tested separately, which sometimes makes a difference and sometimes it doesn't, depending on the circumstances. So just to give you a quick example of that, we've got somebody, Molly here, who's 75, and she's got drawdown funds of 1.1 million. She's previously designated £1 million to draw down. She's already used all of her lifetime allowance, so any excess is going to result in the lifetime allowance charge. So if that is all in one tranche, everything is all in one arrangement, one tranche in there within her pension, then she just has 100,000 tested against the lifetime allowance, because you take the value of her fund, 1.1 million, less what she's previously designated to draw down, 1 million, simply the difference between the two. That's what the lifetime allowance charge would be applied to. However, if she had these in separate tranches, which could be because she had them in two completely different pension schemes, it could be if she had them in two different tranches with one pension with one pension scheme. and different providers do treat this slightly different. But if you have separate tranches within one pension, and actually on her 75th birthday, one of these pots is valued at 800,000 and the other is valued at 300,000, but actually in both of them, she'd put £500,000 into drawdown. So it looks like on the first one, tranche one there, she's put £500,000 into drawdown, and she's probably not touched it, and then, it's just grown. We had the growth on it, but could have been for, depending on when she accessed her benefits, it could have been for like 15 years or something. She's got a growth on it there, and so that growth is tested against the lifetime allowance. So that's actually £300,000 that's tested against the lifetime allowance. In the second tranche, on that one again, she put £500,000 into drawdown, but maybe she's been using that one to take an income, so that's obviously reduced over the years. She's taken out more income than growth, so that one's only worth £300,000. So you can see that her overall fund value is exactly the same, 1.1 million, but because it's treated separately, that second tranche, she had £500,000 in drawdown, she had 300,000 on her 75th birthday, less the amount she put into drawdown. It's a minus figure. You don't get any credit for that. You can't offset it against the other tranche. So actually, where it's separate there, she'd have a lifetime allowance test on the 300,000. Now, that wouldn't happen with us, because the way we do it is that we always take income proportionately across the tranches. So even if you've done, separate BCEs because they've taken PCLS at different times, then we apply the growth proportionately across all the funds, and we take the income proportionately across all the funds. So that wouldn't apply to customers with us, but I do know that there are other providers that do it differently. So that is a possibility that you could have that situation, even if they have all their funds with one provider, if they've taken benefits at different times. So it's just one to be conscious of. It's not always an issue, but just one to be aware of. So back to this dilemma then, age 75. We're looking at, if somebody has got a lifetime allowance issue, they have exceeded when they come to start taking their benefits, they're already over the lifetime allowance or over any level of protection that they may or may not have. What's the best strategy for them? Do you want to crystallize all their funds now? Particularly now, if you look at the fact that the lifetime allowance is frozen, because you can say, well, actually, their growth is always going to exceed. There's going to be no growth in the lifetime allowance. So actually, if they don't crystallize it now, the fund is going to grow by more, obviously, than the lifetime allowance is growing. So therefore, the lifetime allowance charge is going to get bigger. Do you try and manage that by crystallizing all funds now? And then do you take all the income out? Take income to take the growth out to reduce the charge when they hit age 75, or do you want to leave the funds invested if they don't need them, or are you better off just leaving it so they can grow within the tax wrapper, the tax advantages of the pension, but you're going to have a bigger charge later on. So if you fully crystallize now, obviously you're going to have the lifetime charge now straight away. So if you grow, if you remove all the growth, then you're not going to have a further charge at age 75. So you can manage it and completely avoid that second charge. But if you're going to do that, what are you going to do with the income? Do they need it? Obviously, it will depend on the client. Some of them will need some of the income, some of them might need a bit of the income, but maybe not all of the income, depending on what else they've got. If they don't need all the income, would they be happy to pass it on in their lifetime? Are gifts out of income? Is that an option, depending on sort of their family situation and their views on that? Obviously, if you make regular gifts out of income, which doesn't affect their standard of living, as long as you document that correctly, then there shouldn't be any inheritance tax on that. So that that can be a good option for some people. But you don't really don't want to do is take the income out and then just leave it in the estate if you're not going to do anything with it, because if you take it out, then obviously you're going to have inheritance tax on it. So you're taking it out of the pension fund now to basically try and avoid a 25% lifetime allowance charge at age 75, but then it's in your estate and paying 40% inheritance tax instead. That doesn't really make sense. You also sort of need to think about the health as well, because if they die before 75, then you don't have the second LTA test. And also the beneficiaries don't have to pay any income tax when they come to take the benefits. If the client's in good health, like to live post 75, then they have the test at 75, but there's no further test after that, but beneficiaries would have to pay income tax on it. So I've got a case study now where I've put some figures on it, which hopefully should, bring it to life a little bit, and we'll see what it means in practice. So here we've got Emily, who's 60, and she's decided she's stopping work now. Her pension fund is 1.2731 million. She doesn't have any protection. She has got some other sources of income, so she doesn't need to take any income, but she does want to take all of her PCLS out, the maximum at this point in time. So to take out the maximum PCLS, that would be 268,275 under the current lifetime allowance. As I mentioned earlier, it'd be much easier if it was $1 million, and then we just say $250,000, but we are where we are. In order to take that maximum PCLS, she then has to put in £804,825 into drawdown, and that would be fully using her lifetime allowance now. She's still got another 200,000, which is her excess over the lifetime allowance. So the question is, should she just leave it at that? Should she stop, do nothing else for now, just take a PCLS, don't do anything else with this? Or should she crystallise everything now? So basically, if she does that, yes, she has a lifetime allowance charge now, but you're reducing the lifetime allowance charge in the future, especially if she withdraws all of her income to reduce the LTA charge at age 75. So option one then is to fully crystallise. So if she does that now, on that excess, she will have a 25% lifetime allowance charge. So that's £50,000 deducted by the scheme administrator, which gets sent off then to HMRC. The other £150,000 will be added to her drawdown pot, the 804,825. So she's now got £954,825 in drawdown. In order to avoid the lifetime allowance, under the lifetime allowance charge at age 75, she needs to take out all the growth. She was 60 at the starting point. For the next 15 years, she needs to take growth out. Now, obviously, it's going to vary every year depending on performance and her investments, less charges, etc. But let's make an assumption of 4% net growth. If she did that, that works out as just over £38,000 income every year. Now, we said at the start she's got the sources of income, so there's chances are at least some of that she'll be paying higher rate tax on. When she reached state pension age, even just the state pension alone will push her into the high rate tax bracket on there. So you do obviously need to bear that in mind. So her fund at 75, if she'd withdrawn the growth, her fund at 75, even if that growth varies every year, whatever it is, her fund is going to be exactly the same as it was because you've taken everything else out. But also she's going to have had 15 years of taking that growth out, which if say the average on it was 4%, so just over 38,000, 15 years of that. In total, between what's still in the pension and what she's had out, then you're looking at just over £1.5 million in total that she will have had or be able to have. Obviously subject to income tax, whether she's paid tax on the bit that's come out or whether she will have to pay income tax to get out what's still in the pension. So that's option one. Option two, just leave it all, leave it invested. Don't touch anything else. If she's got other sources of income and she doesn't need it, again, we make the same growth assumption, 4% net. Her drawdown fund will have grown to 1.449. And her uncrystallised fund will have gone from the 200,000 up to 360. So 75th birthday, she'll have the 2 BCE tests, one on her drawdown fund and one on her uncrystallised. On the drawdown fund, we've got this drawdown fund of 1.449 less the amount she originally put into drawdown, which was the 804,825, and that 644,175 is tested. And then obviously the full amount of the uncrystallised fund is also tested. LTA charge at 75 is always going to be 25% because you're not taking the money out of the pension. If you want to take the money out of the pension as a lump sum, then you do that before your 75th birthday. Otherwise, on your 75th birthday, the scheme administrator will deduct the 25% charge. The funds will stay in the pension for you to access at a later time. So we work out the charge there, 25% on both of those. It's just over £250,000 is the total lifetime allowance charge, which you deduct from the 1.809 million. And it gives you, again, it's just over 1.5 million, 1,557. So if we compare those two options then, option one, fully crystallised, then you've got 1,527,720. Option two, leave the excess uncrystallised, don't touch anything else. You end up with 1,557,956. So £30,000 difference or thereabouts. I don't think that is a huge difference in the big scheme of things. Obviously, there are timing differences. You've had funds earlier under option one because you've been taking it out for 15 years or some of it out for 15 years. So, you know, it's obviously in fact worth a bit more because you've had it earlier. Obviously with this as well, you don't have to do option one or option two. You can do something in between. But really what I'm saying here is I don't think the lifetime allowance charge or avoiding it is necessarily the reason to be making, you know, the primary factor in making your decision. It's you know, the tax tail wagging the dog or whatever the phrase is. You know, it's not a massive difference. So in terms of what's the best strategy when you're looking at this, these are sort of the factors I think that need to be considered. First one is going to be the health of the client. You know, how likely are they to live in 75? Clients in good health, obviously, yes, this is a potential dilemma that they are going to have this second test on the 75th birthday. For those that aren't likely to make the 75th birthday, then maybe that might sway things differently because, you know, if you crystallise it now and you think, well, actually, if we crystallise all now, it's never going to be tested again because they're not going to make the 75th birthday, then, you know, that could sway things maybe slightly more in that direction. Obviously, tax rate on withdrawals depends what other income they've got, you know, how much tax they're going to be paying if they take it out. And then the big one really as well is what do they do with the money if they take it out, if they don't need it? Are they happy to give money to, you know, family members or whoever on that? Another sort of idea that may work with some clients on when it comes to gifting money is if you have clients with lifetime allowance issues, but they have adult children. So you might have, you know, mum or dad with a lifetime allowance issue that may be higher rate taxpayers. When they're taking their income out, if they choose to withdraw the growth, and they're paying 40% tax on it. But, you know, if they're in their 60s or 70s, they quite likely to have adult children. They may have adult children who are also higher rate taxpayers. If those adult children don't have lifetime allowance issues of their own and aren't likely to, and they have sufficient income and sufficient available annual allowance, what you could consider is mum or dad gifting money as pension contributions, third-party pension contributions to their adult children, which can be, it'd be a tax neutral way of passing things on because yes, mum or dad are paying 40% tax getting the money out of the pension, but if their son or daughter is then getting 40% tax relief on it and going into their pension within the family, that is tax neutral. Maybe not on an individual basis, but between them. And also then you are moving funds out of a pension with a lifetime allowance issue into the one which doesn't have a lifetime allowance issue. So it can be a very efficient way of passing things on, you know, if the circumstances are right for that. What are the sources of income they have? Obviously, that's going to be probably one of the biggest factors. You know, obviously, if they need the money to live on, then they're going to take it out. But if they don't need the money, you know, then they may not need to take it out. Obviously, you know, that's going to influence the decision. And then the last one on here is about potential beneficiaries, because if you don't take the money out and you leave it in, there's likely to be a large fund left on death, then it becomes more important to look at who the potential beneficiaries are. And if you're weighing it out from a tax point of view, you're not then looking at the tax position of the member, you're looking at the tax position of the potential beneficiary, assuming that the member lives to over 75, and so they'll be tax payable on death benefits. Obviously, if there's health issues, then actually there would be no tax anyway, but yes, you'd still consider, you know, who you want to leave funds to. So that brings me on to death benefits. So quick recap then on the basics. Death benefits: if you die before 75, the only lifetime allowance test is on the uncrystallised element, and there is no income tax to pay for the beneficiary when they come to take their income out, as long as the funds are designated within 2 years of death, or when the scheme administrator could reasonably have been expected to know of the death. So it just means it needs to be put in the beneficiary's name, into an arrangement in the beneficiary's name within the 2-year period. Doesn't mean that they have to start taking income. They can leave it untouched for years and years if they want, and then at some point in the future, when they start taking income, then it would still have no income tax to pay. So as long as the designation occurred within the 2 years, or if you're paying out a lump sum, then the lump sum needs to be paid out within the 2 years. If somebody dies after 75, then you don't have another LTA test because it's been done at age 75. You don't have to have it done again. And then the benefits will be subject to income tax, whether paid as drawdown or as a lump sum. But then it obviously becomes relevant, the income tax rate for the beneficiary, which could be children or grandchildren, as an example. So what can we actually pay? So death benefits can be paid in 2 forms, either as a lump sum or as a pension. So as a lump sum can be paid to pretty much anyone, any individual, any trust, charity. In terms of HMRC rules, you can pay it to a company. I don't think I've seen that one, but you know, you can do. It's really anybody, really wide ranging, who can get a lump sum payment. But pension, be that scheme pension, or we do scheme pension, but you know, if you want to have an annuity or drawdown, has to be only for a beneficiary, and a beneficiary isn't just anybody. And obviously, when we talk about the tax position, particularly when somebody dies over the age of 75, it's subject to income tax. If you're taking it, even as an individual, if you're taking that as a lump sum, you know, if you've got a couple £100,000 fund, well, you're going to be paying 45% tax on some of it. Whereas if you pay it into, if you keep it in a pension, then you can draw income as and when you need it and manage the income tax on it. Plus, in the meantime, it's obviously got the advantages of being within the pension tax wrapper. So, lifetime allowance test on death. Some of this is slightly different than it is in the member's lifetime. I've mentioned already about it's only if it's before 75. It's always tested against the member's lifetime allowance, so it doesn't matter what lifetime allowance the beneficiary has, and there's no further BCE for the beneficiaries in their lifetime. It's always kept separate, so somebody has member funds in their own right, and then they inherit funds, they have beneficiary funds. They will always be ring-fenced in a separate arrangement, so they're never tested against the lifetime allowance. The personal representatives are responsible for carrying out the lifetime allowance test on death, not the scheme administrators. That is quite a big difference. We, as scheme administrator, we give the information to the personal representatives about how much the lifetime allowance has been used at the BCE test on death, but we just give that information to them. They will compile it from all the different pensions that the deceased may have held, and they are responsible for carrying out that test and reporting it to HMRC. Any lifetime allowance charge is then payable by the recipient of the benefits. It doesn't come out of the scheme. So we would designate, we'd either pay out the full lump sum to the member or designate to draw down for the, for the member, for the beneficiary, the full amount. They would then personally have a liability for LTA charge if it applied. Obviously, they can access the funds if they need to get it out. And it doesn't matter how old they are either. There's no, you know, because it's beneficiaries funds, you know, children, somebody in their 20s or whatever, can access them. So to pay that charge, you don't have to wait till they're 55 or 57 or anything like that. Lifetime allowance test doesn't apply if the funds are distributed after 2 years. So this is where if you know, it can happen, particularly, you know, things like if you've got property in the pension and you're trying to sell it, or just communication problems, people not coming back to you. in terms of who, when we're trying to gather the information and make the decision about who to distribute death benefits to. If it drags on for more than 2 years, then the LTA charge test doesn't apply, but instead income tax will apply. At the bottom there, I've just got the events that happen on death. So if the uncrystallised funds are used to make a lump sum payment, obviously it's a lump sum, then it's a 55% tax charge. Whereas if uncrystallised funds are used to provide either annuity or flexi access drawdown, then it's only a 25% tax charge. And because this test is always age 75, so as long as you're within your 2 years, then there's income tax, there's no income tax to pay on it, you're always going to be better off going for the drawdown option or annuity than you would be taking the lump sum payment. Because even if you want all the funds out as a lump sum, if you put it into flexi access drawdown, you have your LTA charge 25% deducted, then you can immediately take the whole lot out. That's going to be better than having the 55%. But as I mentioned on the last slide, only beneficiaries can have the drawdown option, not just anybody. So it is important that people are beneficiaries, not just anybody, which I will come on to in a moment. But before that, I'm just going to cover off about charity lump sum death benefits, because again, wealthy clients with LTA issues may be more likely to be in a position to leave some funds to charity. It's only very limited circumstances where this applies. First main one really is that there can be no dependents of the member. So it doesn't matter if you have a husband and wife who are both very wealthy in their own right, and that the survivor has got £5 million in their pension or whatever else, and they really don't need the money from the deceased spouse. It doesn't matter, that you still wouldn't qualify for a charity lump sum death benefit. You would have to wait till the second death, so there's no dependents left of the member. It has to be a charity nominated by the member, or if it's somebody who's inherited as a beneficiary, then it can be them. On their death, I should say, then it can be them. But yes, so even if there's no dependents and the rest of the family say, we don't need this money, we're not dependents, we don't need this money, please can you pay it to a charity? If the member's not nominated themselves, we as a scheme administrator or family members can't make that nomination. If somebody dies before 75, the advantage of the charity lump sum death benefit is that you don't have a lifetime allowance test, which you would do if you had uncrystallised funds normally on death before 75. So I suppose I said before, didn't I, there's no way of avoiding the LTA test. I suppose if you leave it to charity lump sum, this is a way of doing it, I suppose. So maybe I wasn't quite right on that. And it is paid tax-free, which, so if you die before 75, benefits are paid tax-free anyway. So that's the advantage if you die post 75, is that a lump sum death benefit can be paid tax-free. It doesn't mean in other circumstances we can't pay lump sums to charity if these criteria aren't met. It just means they will be treated as normal benefits. So we can pay a lump sum to a charity if there is a dependent, if that's what they want, but it would be subject to a lifetime allowance test if it was before 75, or subject to tax if it was after 75. So I've touched on beneficiaries a couple of times. I'm just going to have a look at the definitions. So definition of a dependent hasn't changed in years. It didn't change in 2015 when the rest of the death benefits changed. It is still spouse of a partner, a child under 23, or dependent due to impairment, can be an older child if they're mentally, physically impaired, and then financially dependent or mutually dependent, which normally covers sort of cohabiting couples and things if their finances are all entwined, joint mortgages, accounts, etc., etc. You then have nominee. So nominee is basically somebody that's nominated by the member who isn't a dependent. So you don't have to put on forms whether people are a nominee or a dependent. Whether you're a dependent or not is a matter of fact, which could be assessed, at the time of death. But the nominee is anybody that's written down, by the member who isn't a dependent. Only can be nominated by the scheme administrator if the member has died with no dependents and they haven't made any nominations. So it's only quite limited circumstances. And then we have successors, which is basically the next step down. So you have to have had a dependent or a nominee inherit the death benefits first, and then on their death, then you have a successor, which will be somebody that's nominated by the person who's just died. whether that's dependent or the nominee or a successor. There is no concept of a dependent of a dependent or a dependent of a nominee or a dependent of a successor. This bit about dependent is only relates back to the original member. So looking at that a different way, what does that look like in terms of who can be beneficiaries? Well, you have the original member. They might nominate their wife, his wife, which would be a dependent. Dependent will always be considered whether the member actually nominated them or not. As a scheme administrator, when we look at the death benefits and look at how we exercise our discretion, we will always consider a dependent to say whether it's named or not. Doesn't mean we will always pay to them, but we will always consider them. You then have nominees, in this case, adult children. That's probably the most common one. So they're over 23, they're not classed as dependents anymore, but you may want to leave funds to them. Nominee can actually be anybody, so it could be his drinking pal from down the pub. Obviously doesn't happen that often, but theoretically it doesn't have to be a family member, is the point there. We then have successor. So the point with successor is it's on second or subsequent death. So and there's no sort of, they're not a dependent because they're not a dependent of the member. Of course, the member can nominate directly to grandchildren. They say they would be a nominee even though they're under 23, even if they were under 23, but they're not a dependent of the member, so they would still be classed as a nominee. So looking at sort of why this all matters and why this is all important, sort of I've got an example here, which is sort of like the tax consequences of getting it wrong, if you like. So here we've got Tony, who's 85. His wife has predeceased him, and he has one child who is John, who is a higher rate taxpayer. So Tony has nominated John to receive his death benefits. That's probably a fairly kind of standard thing, you know, if you've got no dependents, you've got one child, leave everything to that child. It wouldn't be that unusual. That's absolutely fine. But of course, if Tony dies, John gets all his funds. Any income that John takes out, he's going to be paying at least 40% tax on, because he's already a higher rate taxpayer. But John also has two children, obviously Tony's grandchildren, who are both students at the moment. So they are not earning any money, and they are costing John lots of money because he's paying their university fees and living costs, etc. Obviously, he could use money that he inherited from his father in their pension to help with that, but he's going to have this 40% tax deducted. Meanwhile, Martin and Kirsty have got their own personal allowances and their own basic rate tax bands, which they're not using because they don't have any income. So wouldn't it be more efficient if Tony left some of his benefits directly to Martin and Kirsty? So if he made a nomination in their favour, then they would be eligible beneficiaries and able to receive nominees flexi access drawdown, which means each year they could use their personal allowance and take some of that income out tax-free, and possibly use some, basic rate band. Would still be less than if it went via John first, going via their dad. Now, even if they weren't named, the scheme administrator could exercise their discretion and decide to pay some benefits out to them, pay those out as a lump sum. That would be fine. But obviously, if you take it as a lump sum, that's a one hit, so you only get one hit at your allowances. Whereas if you have it in flexi access drawdown, it can stay in there indefinitely, and you can manage it and use allowances each year and take it on an ongoing basis. A couple of points on beneficiaries drawdown just to finish off. Funds will always be kept separate. I think I mentioned that already. Taking income from beneficiaries funds doesn't trigger the money purchase annual allowance, so it doesn't have any impact on how much you can save for your own pension benefits in the future. It doesn't have any impact on your own lifetime allowance, because you it's not tested against your lifetime allowance, it's always tested against the original member's lifetime allowance. You can have junior SIPs. So junior SIPs, you normally have the parent as parent or legal guardian who would manage that along with their advisor for the child. So in terms of the investment decisions. In terms of making withdrawals, you can still make withdrawals on junior SIPs as long as it's for the benefit of the child. So most commonly on that would be for paying school fees. So if they were a beneficiary, you wanted to set up a junior SIP, that would be a very tax efficient way of them having that income and paying that out and paying school fees from that, as an example. SAS beneficiaries, obviously you can, if those of you that deal with SAS, you can have SAS members that join the scheme. But also, if you have, again, if you have children under 18s, they can't be a member of a SAS, a full member of a SAS, because they would have to be a trustee, which you can't do before you're 18. But you can have a beneficiary member of a SAS. In practice, I think you would only really want to do that if it was a family trust, family SAS, because the other trustees are going to be making the investment decisions there. And so you want it to be obviously other people that are going to have look after the interest of the beneficiary, the child beneficiary as well. So you probably wouldn't want to do that, or less likely to do that if it was a non-family SAS. But it is an option, which maybe not everybody is aware of. It's a slightly unusual one. Right, finishing off then, IHT and pensions. Generally speaking, pensions are exempt from IHT. This is because there is no right to death benefits, because the scheme administrator exercises their discretion. And as long as we use discretion and it's not a binding nomination, then the pension is usually outside inheritance tax, outside the estate, so they're not liable for inheritance tax. Can potentially, there might be one or two schemes out there, some who might try and do a binding nomination, that would be a little bit different, but it is very unusual. And in that case, they would fall within the estate. The exceptions when an inheritance tax might apply, first of all, is if you are on your deathbed and you suddenly start loading lots of contributions into your pension to avoid inheritance tax. That doesn't work. And the other one, which we'll look at in a bit more detail, is about serious ill health transfers. But in terms of discretion, as I say, we have to exercise our discretion in order to keep it outside of inheritance tax. And we have designed our form sort of around the rules with legal guidance on this. Some of you may well be familiar with our death benefit form. It is slightly different to how a lot of other providers do it, so I'll just worth mentioning it again. So we have two sections on our nomination form. We have the actual sort of nomination bit, and then we have the expression of wish. Now the nomination bit here says in very small writing, in the event of my death, I nominate all individuals who are eligible benefit recipients as defined in the scheme trustee rules as the persons to whom you should consider allocating any death benefits from my SIP. And then below that, we have the expression of wish part. So this top bit here, this nomination, this is the binding nomination. This is what makes people a nominee, which gives us the ability to be able to pay flexi access drawdown to anybody who meets this definition. And the definition in the scheme rules, it's a lot of words there, I know, it's basically about in relation to a person, so that's the member, are their spouse, grandparents, descendants, and their descendants' spouses, etc. What that basically does, all of that, is gives a really wide-ranging definition of pretty much any family members, including step and adopted, spouses, etc. So that in that case study I had before with Tony and John, actually, if you'd filled in our nomination, our expression of wish form here, this nomination bit here would have in effect given us the ability to say that Kirsty and Martin are nominees because of this nomination, because they are grandchildren, therefore we could pay nominees flexi access drawdown to them. So that would work for them if you'd filled in one of our forms. I gave that example because, say, not most providers do it like that, don't have that little clause in there. So, it's important to be aware of it. So we have this all-encompassing thing on our form. You then have your expression of wish, where, as normal, you would tell us who you want to leave your benefits to. That's absolutely fine. And actually, the real thing, there is a free form box below where you can write any instructions if you want. Some of you, so with other providers, might do the bit where you write in, 98% to the spouse, 1% to the child, 1% to the child. That's absolutely fine. That works. That that gets the name on there as a nominee, and then the scheme administrator can use discretion and vary the percentages and things like that. That does work, but you don't need to do that with ours, is what I'm saying. You might want to write a little bit underneath if you need to say if the spouse predeceases me, then this, that's fine. We do also get asked about letters. If you could just write your own letter, expression of wish, if we will accept that. That's fine, we can accept it, it's not a problem to do so, but it doesn't give you the coverage of this. This is kind of this extra safety net or whatever, it just gives us more flexibility. So I would recommend that you do this, but I'm not saying we wouldn't accept it a different way. Another thing just on discretion, let me just come on to this actually. So we have the discretion as to who death benefits are paid out to. We are guided by the member's nomination, but not bound to it. So we will always look, you know, look at the circumstances of each case and say we will always consider dependents. We have to do that. It might be that they've decided to leave the benefits to the children and not to their spouse because the spouse has got their own decent pension or other funds elsewhere. But we would need to verify that first. We'd want to make sure that the dependent is looked after first, and then if we're happy with that, then we'd probably, you know, follow up the wishes. We would look at things like we'd look at the will, and you know, if we could see that they're catered for in the will, then you know that, you know, we'd look at the whole picture of it. But to say we're not bound by it. Just another note quickly on that is that with expression of wishes, even if they've not changed for years, it is good practice still, you know, when you have your annual review meeting, just to do an updated one and let us have it. It makes our life so much easier when a client dies, because we could look at it and go, well, actually, this is only dated 3 months ago. We know this is going to be pretty much up to date and this is what they want. We don't have to look back that far. Whereas if you've got one that's 10 years old, we go, actually, have the circumstances changed? Are they still with that person? Has anybody been born, died, divorced, separated? You know, all those things that we have to kind of, if the older it is, there's more that we have to look into, and it's likely to take longer, you know, to do that and to make the distribution. So I say it's a good habit to be in, to just update it, even if you're only changing the date on it, just so we know that that is still current. Okay, last thing we're going to cover is about serious ill health transfers. So if somebody transfers their pension benefits whilst in ill health, then potentially the funds could be liable to inheritance tax. In terms of the legislation on this, there's actually no time limit, but in practice, you only have to report transfers made in the 2 years prior to death. So those are the only ones that are ever really like to be looked at by HMRC. Because it is potentially a chargeable lifetime transfer, there is no spousal exemption. So it doesn't matter if the death benefits are going to the spouse. That doesn't make any difference. You could still have this potential liability. The other thing we get asked about is, well, actually, if the death benefits, the recipient of the death benefits is the same on the original scheme, on the seeding scheme, and it's the same on the new scheme, then where's the potential loss to the estate? And whatever my views on there, and I may agree with you, it's not how HMRC look at it. HMRC look at this as though you take it at the point of the transfer, you have the option of pointing the benefits to the estate, and you chose not to do it, and therefore there is a potential loss. Now, there is an exemption which was verified, if you like, underneath the Staveley case under section 10 of the Inheritance Tax 84, which is dispositions not intended to confer a gratuitous benefit. Basically, what that means is if you can demonstrate that you are making the transfer for the benefit of the member in their lifetime, then you should be able to rely on that exemption. So the reason you are doing this transfer is not to improve death benefits, it is for the member, which could be, you know, so they can access their funds in a way they couldn't do in their original pension scheme, or because they want to make an investment they couldn't do in their pension scheme, or charges, or whatever it is. But you would have to have that very well documented, you know, to evidence that if it got looked into. But obviously there are times where you are going to make a transfer in serious ill health because you want better death benefits. Somebody's going from a DB scheme where they've got no dependents, so basically the pension would die with them, whereas if they move it to the DC scheme, they can leave it to something, to a family member who's not a dependent. And you know, even if you pay inheritance tax on it, it's better to get, you know, percentage of something rather than nothing. So in terms of the loss to the estate, the important thing to remember is it's not the whole transfer value. HMRC have told us that the way they calculate this, the loss to the estate, is the open market value of the death benefits, which could have been directed to the estate at the point of transfer, less the open market value of lifetime rights in the receiving scheme. So case study to demonstrate that. Got John, who's terminally ill, given less than a year to live. He transfers $500,000 from his retirement annuity contract to his SIP, and he dies within 12 months of the transfer. His executors are going to report that, and they need to do that on the IHT 409 form. But what is the potential liability? So the loss to the estate then, the open market death benefits are going to be of value close to the transfer value. So if we assume 3.5% growth from the date of transfer to date of death, and then apply a discount rate, use 7.5% here. That's something that HMRC have used in emails to us when they've sort of been explaining this. So let's say that leaves 480,000. Less the open market value of the lifetime rights in the receiving scheme. So under pension freedoms, the maximum you can take out is the whole lot, which you could do under a UFPLS payment. You would get 25% of that tax-free, 125k, and then the rest of it is subject to income tax. So if we assume there's no other income tax, that works out as you get about £220,000 after tax. So your total lump sum payment there is 345,000 approximately. So the loss to the estate is the difference between those two figures. So you've got the £480,000 open market death benefits less the 345 open market value of the lifetime rights. So it's £135,000. So that is the figure to which inheritance tax could potentially apply in this example at 40%. So it works out as just over £50,000. So the point is, it's not 40% of the whole transfer value of £500,000. It's sort of significantly less. So yes, you do need to be aware of inheritance tax, and yes, if you're advising a client to transfer in serious ill health, there is this potential charge. But you know, it's maybe not as bad as you might have thought. It's not as much as 40% of the transfer value. So that is me. Really, sort of the key points from the session is the lifetime allowance dilemmas. It's age 75 thing. It really does depend on the client's individual circumstances. I don't think the lifetime allowance charge itself, you know, if you looked at those figures, there's an argument strong enough one way or the other. It's going to depend on their individual circumstances, such as, you know, sort of health is the big one, potential beneficiaries, how happy they are gifting money out of income, what rates of income tax they pay, etc. Death benefits, I say review nominations regularly. But I say if you can give us, you know, an up-to-date one each year, that would be fantastic. And ill health, yes, there may be inheritance tax, but it's maybe not as bad as you might think, even on ill health transfers. They don't always come after it as well. But it's definitely not a reason not to transfer. So that is all from me for today. I do hope that has been useful, and thank you very much.
Thank you, Lisa. So that brings our At Retirement session to a close, and I want to thank you again for joining us today. As mentioned earlier, a survey will pop up immediately after this webinar closes. We'd really appreciate you completing this to tell us what you thought of our content today. CPD certificates, a copy of the slides, and a link to today's recording will be sent to you tomorrow. Any questions at all, please note them on your form and the team will get back to you. Until we see you in person later in the year or at another webinar, please take care.